continue on with accounting. In the first few chapters, we've learned about the accounting equation, debits and credits. We've learned about the different accounts and the balances and how they work, journal entries, T accounts. It's critical at this point that when I mention these things, you know exactly what I'm talking about. Because if you don't understand what I'm talking about or are a little bit confused, the rest of the semester is going to be a lot of confusion for you. You've got to get all of these concepts down. What an asset is, what a liability is, what retained earnings is, what debits and credits, and how the debits and credits affect assets, and how they affect liabilities, and how they affect equity, because they affect them each differently. So if you're still a little bit confused about that, you have got to go back and understand this stuff inside and out. Okay, let's continue on. The first part of this chapter talks about the adjusted trial balance and that kind of stuff. We're going to move a little bit past that because from the last chapter, we did those adjustments, because remember, at the end of the year, there are certain adjustments that need to be made. So we made those adjustments. Now, it's the end of the year, the adjustments have been made, our trial balance has now been adjusted, so we've got our adjusted trial balance, all the right numbers, we can prepare our financial statements. Okay, so we need to make sure we understand how to prepare financial statements. And now, it's all done. We're all done. The accounts are in balance, but there's a problem because when you start the new year, our revenues and expenses and our dividends still have balances in them. Well, when you start a new year, revenues, expenses, and the dividends account should all be zero. They need to be zeroed out. So that's what we're going to learn about right now. And I'm going to look at some specific accounts. Our revenue account, let's assume, has a $10,000 balance. And I'm just doing a really simplified example. Let's say we just have two expenses, because normally a business will have lots of different revenue accounts and lots of expenses. I only did one revenue and two expenses. So wages, $5,000, rent of $1,000, so our net income is $4,000. Let's say we also had dividends of, let's say, $1,500. Okay, and our beginning of the period retained earnings was $21,000. So now, this is the information, this is what took place during the period, and retained earnings had a beginning balance of $21,000. Well, the first step is now, since we're going to be starting a new period, we don't want revenue of $10,000 anymore. We need to get rid of that balance in there because the new period's starting and we need to start from zero. So what we do is we close it out. So we're going to take $10,000 and we're going to debit revenue because revenue has a credit balance. So we debit it, that now zeroes out the account. And what we're going to do is we're going to temporarily put this in an account called income summary. Now you probably can't read this, but it says income summary. We're going to temporarily put this in that account. So there's our $10,000 moved over into income summary. So that's the first step. The second step is to close out the expense accounts. Well, expenses have debit balances, so we're going to have to credit them. So I'm going to credit wages and credit rent. So wages, $5,000. Rent, $1,000. Now, you know that every single transaction has to balance out. So we have to have $6,000 of debit because we've got $6,000 of credit. Well, where are we going to put that? In the same new account, income summary. Okay, so if we put a T account for income summary, let's put it over here. Income summary, what we've done is we've got 10,000 here, and then 6,000 on the debit side because we've got the 10,000 and 6,000. So this is what's in income summary. So we can see that the balance in there is 4,000. Okay? Now, the next step is to close out this income summary account. Well, the reason why we put it in income summary is just so that we can see that that is the profit. See, there's our net income, our profit for that time period. So now we're going to close out income summary. Well, income summary has a credit balance, so we're going to debit it. Now, where do we put that? Well, who owns this profit? Well, the owners own the profit. So we're going to put it in, I'm going to abbreviate here, retained earnings, RE, retained earnings. So I'll just move it right over there. And there's our retained earnings. Okay, so retained earnings is an equity account because it belongs to the owners, and what it does is it increases the value of their ownership. Retained earnings is that profit retained in the company year after year. Okay? Now, there's one other thing that I put up here. I put dividends. Dividends are distributions to the owners of the company. So the shareholders, they get dividends typically every year. Sometimes it depends on the company. It could be quarterly, annually, semi-annually, maybe none at all. Okay? But we said that the owners during this time period got $1,500. So dividends they're similar to an expense. They're not on the income statement. They're on the statement of retained earnings, but they're treated similarly to an expense because they reduce retained earnings. So it does have a debit balance, like expenses do, so we're gonna have to credit retained earnings. Dividends. So we credit the dividends, $1,500, and what we do is we debit retained earnings, because we're closing out the dividends. The dividends have $1,500 debit balance, so we credit it. So now this has been zeroed out, and now where are we going to put that $1,500? Because our journal entry must balance, we're going to put it in retained earnings. When I say put it in retained earnings, it's going to reduce retained earnings. So let's do the same T account, but with retained earnings. Retained earnings started with $21,000. That was its beginning balance. What's the balance now? Well, from our journal entries, we've increased it $4,000 because that was the profit. We've increased it $4,000, so there's our profit. There's our revenue less expenses. So right now it's got a balance of $25,000, but we had dividends, so we have to reduce it. See right here? Here's the debit. Here's the reduction. So we reduce it by $1,500. So what's the ending balance? The ending balance is going to be $23,000. Can't really write that low. $23,500. That is now our balance in retained earnings. So it started the period at $21,000 and it's ending the period at $23,500. So that's where we're putting the dividends, revenues, and expenses are all being moved into retained earnings because this is the retained profit within the company. And it's the net income less the dividends. And then what's happened to revenues, expenses, and dividends? They've all been zeroed out. Okay, so this is the real critical part of the chapter, to understand that at the end of the year we've got all of our balances in our accounts, but now we've got to do this closing process. This is the closing process, the four-step process. We close out revenues, we close out expenses, we close out the income summary because that's where we put the revenues and expenses, and then we close out the dividends to the retained earnings. Okay, the last part of the chapter talks about the classified balance sheet. I think that's pretty self-explanatory. Make sure you go through that and you understand how this balance sheet is set up. Pay particular attention on the different sections that are in a classified balance sheet, why they're in that section. Okay, so make sure you understand really clearly, carefully that what assets are in the classified balance sheet. Well, all the assets are, but how they're categorized in each section. Same thing with the liabilities. You'll notice that the equity isn't any different. It's how we've always seen it. Okay, good luck with this chapter, and make sure that you're spending lots of time going over probably the previous chapters and make sure that you understand this one really well.